Welcome to a video on recognizing revenue for contracts that contain multiple performance obligations. We've seen two cases of single performance obligations, the performance obligation to deliver the equipment, and then the separate case, the performance obligation to provide access to the online workout platform. Now we're going to do a case where they're both present. Let's talk about it in general first. Recognizing revenue for contracts that contain multiple performance obligations. There are two goods and or services they're often bundled for a single price. You've heard that on commercials a lot, bundling. These performance obligations under the two goods and or the services might be completed at different points in time. But the steps are the same. Revenue recognition steps. Identify the contract. Identify the distinct performance obligations. Determine the total transaction price. Allocate that transaction price to each performance obligation. And then recognize in revenue allocated to the respective performance obligations when that particular obligation is satisfied. So the question comes up, is the performance obligation distinct? In other words, should we separate the performance obligations? And the answer is, we separate the performance obligations if the good or the service is distinct from other goods or services in the contract. Well, how do we know if it's distinct? It's considered distinct if the following are true. They are separately identifiable from other goods or services in the contract, and the customer can use the good or service on its own or in combination with goods or services it could obtain elsewhere. They are distinct if both of those are true. Okay? So if they are true, we will allocate the purchase price to the two distinct performance obligations. And how will we do that? Well, we will use a process that you'll use a lot in accounting. It's called pro rata. And in this case, pro rata based on the price of each standalone product or service as a percentage of the sum of the costs of each product or service in the bundled contract. Then we multiply those percentages times the bundled contract price. Let's demonstrate this with an example, a case. Peloton manufactures treadmills and exercise bicycles that can be sold with a prepaid subscription to Peloton's library of live and on-demand fitness classes. You remember that from the last two cases. Now assume the following. The Peloton bundle includes a treadmill and or an exercise bicycle and a 1-year subscription to the Peloton multi-user library of live and on-demand fitness classes. The cost of the bundle for the treadmill is $4,120. If you just buy the treadmill and the service. If you buy the exercise bike and the service, it's $3,120. So in other words, you get the service for $120 rather than $600 if you buy it in conjunction with the equipment. The bundle price for one treadmill, one bike, and 1 year of online class access is $7,120. So you save yet another $120 if you get all three. Peloton sells the treadmills for $4,000, the exercise bikes for $3,000, without the subscription included. You saw that earlier in the earlier case. And Peloton charges $600 per year for the workout library standalone without purchase of equipment. You saw that in case 2. Now, offering this bundle on January 2, 2024, Peloton sells and delivers a bundled treadmill, exercise bike, and 1-year subscription to the online workout library to a customer. The customer paid cash. So required. Address the 5 steps to revenue recognition and show the journal entries with the appropriate dates, again, so important, that Peloton will record associated with these economic events. So again, we'll identify the contract with the customer. We'll identify the performance obligations in the contract. We'll determine the transaction price. We'll allocate the transaction price to each performance obligation, and we'll recognize revenue when or as each performance obligation is satisfied. Okay, so as always, I hope that you will take a moment, pause this video, and work the case. Okay, welcome back. I hope you had luck working the case. Here's my solution. Here's my discussion. So the first thing we want to do is address the 5 steps to recognition. Okay, so identify the contract with the customer. In this case, we have we deliver the treadmill, deliver the exercise bike, and they are both in working condition, and provide access to the online platform. So the contract has really 3 components. The performance obligation in the contracts. The performance obligations are 3. Deliver a working treadmill. Deliver a working exercise bike, a well-functioning exercise bike. And provide unlimited access to the library of online workouts. Determine the transaction price. Okay, well, I know what that is. That is $7,120 is the agreed upon bundle price. Allocate the transaction price to each obligation. Okay, there's something new for us. And then recognize revenue when or as each performance obligation is satisfied. So we will complete these steps in conjunction with doing the journal entries. Okay, so again, we have the contract with the customer has 3 components. We need to deliver a well-functioning treadmill, a well-functioning exercise bike, and then we have to provide unlimited access for the entire year 2024 to the buyer. All right. So let's talk about these. And obviously, eventually, something will go into the general journal. But I also have notes on here. And the first note is to talk about the purchase price and the allocation of the purchase price. So remember that the standalone price of the treadmill is $4,000. The standalone price of the exercise bike is $3,000, and the standalone price for the access to the workout is $600 a year. So sold separately, that's a $7,600 value. Bundle price is $7,120. Now, if you do the math on this, of the standalone price, $4,000, if you divide that by 77,600, you will see that that is 52.6%. The $3,000 as a percentage of the $7,600 price of the goods is 39.5%. And the $600 is 7.9% of the price of the $7,600. And that will add to 100%. Okay. And so the way we're going to allocate the price is we're going to allocate these percentages to the $7,120 bundle price. Here's some written notes that I prepared. The sum of the standalone prices in the bundle is $7,600. Of that total, the treadmill is 52.6%, the exercise bike is 39.5%, and the online library access is 7.9%. Thus, the $7,120 bundle price is allocated 52.6% to the treadmill, 39.5% to the exercise bike, and 7.9% to the online access, class access. Now, I know I read that quickly, so if you need to, by all means, pause the video and write any notes you wish along with what I worked on down here. Okay, so armed with that information, we can now recognize the sale. Well, what do we do on the day of the agreement? Well, we do have an accounts receivable for $7,120. It breaks out this way. The sales revenue for the treadmill is $3,745.12, which is 52.6% times 7,120, or it's 52.6% of 7,120. The exercise bike, we don't allocate 3,000, we allocate 2,812.40, 39%, 0.5% of 7,120. And then remember, with the online library access, that's deferred revenue, liability of $562.48 rather than $600, which is 7.9%. So what we didn't do here, remember, is we did not recognize $4,000 for the treadmill, $3,000 for the exercise bike, and then $120 for the deferred revenue. You see the difference? That's the key. We used a pro rata to take and allocated the savings because the customer was willing to do the bundle price, was to buy all three. We allocated the savings for the customer to all three performance obligations, all three goods/services. And so that is to record the sale of a bundled treadmill, exercise bike, and 1 year online library access. Oh, and by the way, remember, we still have to recognize another economic event occurred, and that is a couple of assets came out of our warehouse and went to the customer. So we have to recognize the cost of goods sold and the reduction in inventory because that was yet another economic event. So after this, we have the accounts receivable on the balance sheet asset side. We have the deferred revenue on the liability side, and we no longer have the equipment, the treadmill inventory, and the exercise bike, 1 unit of inventory in inventory. On 125, the customer pays the $7,000 on January 25. The customer paid the $7,120. I apologize. I think in the facts I said that the customer paid cash. So I apologize for that. You wouldn't need if cash was received up on 1-2, you wouldn't have this. But let's go ahead and go with it. That the sale was made on account, and now the customer pays on the account. And then at the end of January, we recognize a month's worth of revenue. Notice the value. Did you get that when you worked the case? It's not 50. It's 1/12 of 562.48. So the revenue is 46.87. And I should have here 228, 330, and so on. When these will be, we will continue to recognize revenue. And we will do that for the entire year. And that is the accounting for a bundle of performance obligations bundled together for one price. Again, you watch TV much, you'll know that that's going to be a fairly common transaction. So many services and goods are sold in bundles to induce additional sales. All right, thank you for your attention and have a great day.